off your video, then we can restart it once. Hello and welcome. I think we're going to start in a minute. We're just giving some time for our attendees to join in, and our audience on Facebook and on other social media channels also to join in. So do bear with us. We will start the webinar off in just a minute. Thank you. All right. We can start things off. Paul, Tom, if we can have you switch on your videos as well. Awesome. So Steve Jobs once said, you can't connect the dots looking forward, you can only connect them looking backwards. And while that makes a lot of sense, I'm also reminded by my wife every day that it's also not possible to go forward while looking back. What does this have to do with the session, you may ask? And the answer is everything. Today, we take a look back at what 2021 had for us, examine the events, the occurrences, the highs, the lows, and try to glean the lessons and learnings we need to carry forward with us as we move our gaze forward into 2022. Hello, everyone, and thank you for joining us in today's webinar, where we take a closer look at the road ahead outlook for 2022. Before I introduce our guests, a little bit of housekeeping. This webinar is due to last about 60 minutes, and if for any reason you get disconnected or logged out, you can use the same link emailed to you to rejoin. We have this available as a recording, and it will be available on our social channels as well. Also, we will have time for question and answers from our audience members who've joined in. So definitely do type in and submit your questions in the Q&A box that is there at the center of your screen. Yep, and with that, let me kindly allow me to introduce our guest speakers for today. First off, we have with us Mr. Tom Planterose, who is the Senior Portfolio Manager with Sanlam Private Wealth UK. He has been looking after private clients, trusts, corporates, and charity accounts, managing assets on their behalf with Sanlam since 2011. Tom gained an MA in Finance and Business Law from Heriot-Watt University. He's a member of the Chartered Institute for Securities and Investments with a Level 7 Chartered Wealth Manager qualification. Also with us today, we have Mr. Paul Jackson, who's the Global Head of Asset Allocation for Invesco. Paul provides commentary on macroeconomic events and analysis on how they impact capital markets. Prior to joining Invesco, Paul worked at Société Générale, SocGen as it's more popularly known, in both Paris and London, holding positions as macro specialist sales, equity strategist, and head of research, during which time he wrote under the Belgian dentist label. And that's a story that we should get into at some time, Paul. He started his career at Morgan Stanley in London, where he worked in corporate finance and equity research before transferring to New York, where he joined Morgan Stanley Asset Management as portfolio manager. He holds a BSc in economics from the London School of Economics and a Master of Philosophy in Economics from Oxford. Also with us today is Ms. Nilam Varma, who is the Vice President and Head of Investments for Continental. So Nilam is a seasoned finance and banking professional with over 20 years of experience across investments, private banking, and wealth management, both corporate and commercial banking, real estate finance, retail banking, and Islamic banking across India and the UAE. She holds an MBA of Finance from New Hampshire University in the US, is an advanced strategic management expert from IIM Ahmedabad, and holds a mini MBA from Harvard Business School. She's also a certified wealth manager from the American Academy of Financial Management and ICWM from CS UK. So Tom, Paul, Nilam, a big welcome to you to the webinar.
Thank you, Anselm. Good to be here.
Perfect, thank you. Yeah, my name is Anselm Mendes. I'm the Executive Director of Sales at Continental, and it is my pleasure to be a host and moderator for today's webinar. So, all right, let's get into the thick of it. Let's talk about it. Let's talk about 2021, a year where we probably saw it all. Hope in the beginning, as we sort of seemed to see the worst of the second wave, get through that, and then followed quickly by worry and concern as then we had a third wave and a fourth wave. And then we had so many things happen on the investment side. The markets, I think we've seen it all, 52-week highs and 52-week lows throughout the last year. When you look back at 2021, and from your perspective, how do you think markets performed in 2021? And Tom, if we can start and go with you.
Yeah, of course. Thanks, Anselm. I guess the simple answer from our perspective is better than expected. We were quite surprised at how well equity markets in particular performed. The US markets reached new highs, shrugging off COVID mutations and threats of rising inflation and the prospect of a changing monetary environment. I think what was probably quite interesting was you began to see a bit of a divergence between different regions. And certainly in the latter part of the year, government intervention in China triggered weakness in Asia-Pacific markets. And we continue to see the cyclical sectors and the momentum strategies perform well over the course of the year, like they did in the latter part of 2020, ignoring somewhat the kind of fundamental aspect of businesses, and that growth at any cost or any kind of risk seemed to be the maintained mantra there. I think something that we've looked at quite closely was how markets performed as a whole. So if you look at the MSCI World Index, for example, it continued to reach new highs over the course of the year. But what would be interesting is that if you equal weighted that index, so rather than having the behemoths of Amazon, Apple, driving that market. If you equal weighted all of those stocks so that those stocks had a similar impact to a lot of the smaller companies in that index, actually your returns in the second half of 2021 were rather benign. So there's still a handful of larger businesses that are driving markets and certainly masking maybe the kind of underperformance of a long tail of smaller businesses. I think away from equities, the kind of easy area to see where there was weakness was in government bonds. We saw yields go up on kind of US and UK government bonds, and that was a general trend and quite natural when you're seeing higher levels of inflation, but central banks not yet willing to raise interest rates to combat it. It's cheaper for them to finance their debt when inflation is running higher. So probably a reason why they were slightly reluctant to do so. So the government bond market has certainly bear the brunt of kind of certainly flows when you look at money coming out of government bonds and going into those momentum strategies and equities that we mentioned earlier.
Sorry, I was talking to myself there. But thank you, Tom, for sharing your views. And we're going to head over to Paul. Paul, how would you summarize 2021? What is your outlook on it?
Yeah, I think 2021 was kind of surprising in that the global economy did as well as it did when you go back to where we were in 2020, what the pandemic was doing. But of course, we had the vaccines being rolled out. There were treatments that became available when you had COVID, you went into hospital. There were ways of dealing with it over and above the vaccines, which made it less problematic. And in fact, 2021 was really a year of economic rebound after a sharp recession in 2020. The rebound continued in 2021. And the asset performance that we saw really fit with that cyclical assets performed the best, by which I mean things such as commodities, real estate, equities, and the defensive assets, as Tom has already mentioned, government bonds, gold, investment grade credit, they all produce negative returns at the global level. And yes, there were regional differences. US assets tended to outperform, which for me was a bit of a surprise. But the real underperformance was obviously Chinese equities and emerging market assets in general. Interestingly, Chinese equities did very badly for some of the reasons that Tom has mentioned. Everybody wanted them in 2020, nobody wanted them in 2021, but Chinese bonds actually did very well. Chinese government debt was the top performing debt market. So it's a different picture depending on which asset class you look at in terms of the way that China performed. But overall, it was a year for cyclical assets.
Thank you, Tom. And yeah, sorry, Paul. And very interestingly, the point that you mentioned in terms of China and the bond markets there. Nilam, how do you see what panned out in 2021?
Well, I agree with both Tom and Paul. It was a crazy year in many respects and reasons, which I think we've discussed. But putting all that in the backdrop, I think stock markets gave out very, very solid performance in 2021. A few brief sell-offs that we saw in the US. S&P 500 gained double digit. Actually, it was at 27% approximate. Dow Jones gained about 18%. We saw NASDAQ on a roll with 20+%. It was a year wherein US was going through a heavily contested presidential election. We saw assaults on the Capitol Hill. We saw historically high inflation, which has not happened in the last almost 40 years. Massive supply chain disruptions because of the COVID. And everyone was expecting that 2020 and 2021 will look alike. But nothing of that sort happened. I think most of the stocks, they notched all-time highs. And whether it was a COVID-19 pandemic, the way we called it, or Delta or Omicron, the variants kept coming in, the numbers kept going high. I think very sadly, a lot of deaths happened, but stock markets were on a roll. So we saw actually S&P 500 notching an all-time high. Of course, Paul just touched on the Chinese government initiatives to start imposing stronger rules on the internet companies. And those were the companies that were the flavor of 2020. And because of the move by the Chinese government, I think the segment started grossly underperforming and gave negative returns. There were periods wherein we found those as opportunities to invest, and there were events wherein we felt that clients were actually finding it very, very difficult and they were panicking. We also saw a lot of defaults towards the third quarter in the real estate segment, which was completely unheard of because you don't see liquidity issues coming in from China, especially on one of the largest segment, which is real estate. Talking about our own India, I think BSC, which is the landmark index or the flagship index, it gave the best performance across Asia. And it was kind of the second best performance in the world, delivering more than about 10,000 points growth. So overall for our clients or as investors, the market was a beautiful year. We are expecting 2022 to give the similar returns. Oh, I missed out talking about Bitcoins. I think Bitcoins were the front runners here, gaining more than 60%. Oil was at the forefront with more than 55% green. So overall, I think the major segments that we were looking at and tracking, they all delivered returns, except for the investment grade credit, like Paul mentioned, or the US Treasuries. It was overall a very good year for investors.
No, thank you for that. Yeah, I think absolutely right. Bonds were probably that was the worst performing year, I would assume, for bonds in a long time. And traditionally, bonds don't really do that. But thank you so much for your insight. And that brings me to one question. And you sort of mentioned it there, Bitcoin and cryptocurrency. But I'm not going to get into that right now. But was there anything that surprised you about the markets last year? I mean, we can start with you, Nilam, and then we can go to Paul and Tom if there's anything that you found surprising or interesting in the past year.
Well, a lot of things surprised, but the biggest surprise was that a lot of companies came in and made that leap from being, kind of privately held to getting publicly listed via the SPAC route. I think it was a record year. More than 900 companies came in and they raised a huge amount. If I have to look at the number runs into $200 billion or more. It's a huge jump from the previous year. Then we were looking at record high. While we were looking at these record highs on the stock market, we were looking at also a growth in the total market cap of crypto, which actually had tripled during this year. And, for example, the Bitcoin, which was trading at about $23,000, touched an all-time high of $67,000, which was unheard of. What also surprised was that the labor market in the US was recovering. And it had added more than 18.5 or 19 million non-farm jobs, which was again unheard of because everyone was cribbing that there's huge amount of unemployment. But the number of people who started filing for unemployment was at a record low last year. So that was a very big surprise coming in from the US. Typically, when people are looking at high inflation and they were concerned about how high inflation would derail the economic growth and the stock market would crash, all those things actually never happened. While I would say the annual inflation was at all-time high, maybe at about 7%, which was again unheard of in US, and everyone was talking inflation, everything else was flying high. So, for me, that was a big surprise.
Paul?
For me, the big surprise was that bond yields didn't go higher. Given what the economy was doing and given that central banks were signaling that they were going to start tightening, I really thought that yields, especially in the States, would go higher than they did. And the fact that yields actually stayed quite low and went quite low again during the course of the year had a number of knock-on consequences, one of which was that it enabled growth stocks to get a second breath during the year, but also it did encourage flows into assets such as Bitcoin and crypto and gold. If you think that the real yield on treasuries is the opportunity cost of holding these no yielding assets, these non-yielding assets, then if yields are going down, then naturally these prices go up. Everybody's flush with cash. Governments have been pumping money into the economic systems. Central banks have been pumping money into the system. So there's a lot of cash out there. And when yields stay low, that money has to find a home somewhere. Actually, I'm just writing a piece about alternatives at the moment. Bitcoin wasn't the top performing asset. Private equity actually did better last year, which was the first year going back to 2011 that Bitcoin wasn't either the top performing asset amongst the ones that I look at or the bottom performing asset. It came in second rather than top or bottom. I've got a slightly different view, I think, on things like Bitcoin. I hold to the John Paulson view, which is that, yes, it's a limited supply, but it's a limited supply of nothing.
And we will come to that. I think that's an interesting question, given what we've seen in the past year. But yes, some interesting facts that you pointed out, some surprising ones. I didn't really realize that Bitcoin wasn't either at the top or the bottom, and we've been seeing that for a few years now. And yes, Nilam, like you mentioned, SPACs certainly have, for what was once probably considered a last case use of a model or a structure, they've become extremely popular. Tom, any surprises that you found in the last year?
I think not necessarily on top of what Paul and Nilam have already said. I think how candidly markets seem to shake off the kind of dawn of a changing monetary environment was probably the biggest surprise for us. We expected maybe a more rational year for markets, and we expected that those momentum strategies maybe to start to fade a bit more than they did in 2021. They continue to do very well, and we saw some price earnings ratios really expand to some quite astronomical levels, kind of almost .com bubble levels. And I think it's really just maybe it's kicking the can down the road a little bit further as to what we might begin to see this year. I think maybe what we're already starting to see this year in terms of equity market returns. But I think, I agree entirely with Nilam and Paul that just the shrugging off of a real change, higher inflation. We all expected higher inflation, but we maybe expected asset classes to react a bit differently to how they did.
Excellent. Thank you so much. And with that, we'll go to our first poll question that we've got for our audience. And if the team will bring it up on screen so that our team members can answer that. The question is, what returns do you think the S&P 500 will deliver by the end of 2022? So yes, we're asking you to make a prediction. Predictions are always fun. And it's especially nice to come back and then see what we did predict, in the year ahead. But like Nilam mentioned, this 2021, we saw close to about 27% or even more in the S&P 500. What do you expect in 2022? So please put in your votes, and we will come back to the results in a moment. Just a reminder before we get to the results and while we wait for the results to come in, if you have a question that you'd like to ask our panel, please enter it in the Q&A box and hit the submit button. Don't forget to hit submit, it's important. And send your questions in so that we can get our panelists to answer them. We will try and answer all of the questions that we get, either live in the forum or those that we can't take in the forum. We will send your response from the panel to your email. So yes, please do send in your questions. I don't know if we've got the results of the poll yet, but if the team can put up the results, or we can go to the next question. There we go. We've got the results up on screen. And a good 45% say that they're expecting it to deliver about a 5 to 10% return. The 30% of our audience believes that it will be in the 11 to 15% range. Surprisingly, no one expects it to be above 15. I think we've got a very sensible set of audience clients joining us in, and about 25% expect it to be under 5%. Very interesting indeed. So that also sort of feeds in well to our next question, right? And that is going to our expert panel. We're going to put you on the spot. How do you anticipate markets will perform this year, especially given the last 2 years' performance has been fairly spectacular in a sense, especially in the equity markets. Would you say that investors can expect double-digit returns from equity markets this year? And how would you anticipate the performance really? So we'll start with you, Paul.
Yeah, just on the question of the S&P 500, I wouldn't be surprised to see the S&P 500 finish the year lower than it started. In fact, it's one of, every year I borrowed an idea from an old colleague, Byron Weem, so I publish a list of 10 surprises for the year, and one of them is, that's kind of the first one on the list. But for markets in general and looking across assets, what we're doing now in terms of the global economy is we had deep recession, we've had strong rebound, and now we're going to be settling down, I think, to something which is more like normal growth. So it's actually going to feel a bit like a slowdown from the rates of growth that we saw in 2021. And although we're only slowing to, say, trend growth, nonetheless, it is a slowdown. And typically, what's interesting is during those slowdown phases, asset class performance tends to converge. So last year, there was massively divergent performance between cyclical assets and defensive assets. But I think in the sort of environment we're going to see in 2022, we're going to see much closer returns across assets. And because I think bond yields will continue rising, number 2 on my list of surprises is that the 10-year Treasury yield goes to 2.5%. So I think there is still downside on government bond markets and bond markets in general. But I don't think we will see what we saw last year, which is negative bond returns and very high equity returns. I think the equity returns will be much more difficult to come by. And I think that'll be true across most of those cyclical assets. I still think overall that cyclical assets will give better returns than government bonds, for example. But I think that the margin of outperformance is going to be much more limited. And we didn't mention, well, Tom did mention that at the very beginning that central banks last year were still providing a lot of support. This year, clearly they are now removing, the big central banks are removing that support. Apart from, if you include the PBOC in that category, apart from the PBOC, which cut rates yesterday, big developed world central banks are removing support. They're stopping buying assets. They've started raising rates. And although I think equity markets can continue to go up in that sort of environment as they have done historically, I think it makes the environment much more volatile. And when you go through periods when if bond yields spike upwards, as we have seen in the last couple of weeks, when you're going through those adjustment phases, equities become more volatile, there's downside, and it takes them a bit of time to digest those movements in bond yields. So I think equity market is going to be more volatile, still outperforming bonds, but real estate still outperforming bonds, but by a much smaller margin. And it's going to feel quite difficult, I think, at various points this year.
Thank you, Paul. We go to Tom. Tom, if you'd like to give us your sense of what to expect in the markets this year.
Yeah, I think fairly similar views to Paul. I think with one thing for sure is guaranteed this year is that volatility will pick up as we adapt to central banks making changes to interest rates and that kind of global tightening. That's naturally going to cause higher levels of volatility, particularly in equity markets and in the government bond markets as well. Or similarly to Paul, it really wouldn't surprise me if the MSCI World Index finishes the year in a very similar position to where it started, but you'll get quite radical differences just in between them. I'd be very surprised if we do see double-digit returns from equity markets as a whole this year. I think Paul's point about central banks taking action is very poignant, and I think what is going to be interesting is to see kind of who moves first and who moves later. I think certainly the US and the UK seem to be quite keen to raise interest rates and start to combat that inflation as we see that economic slowdown as Paul was referring to. That doesn't necessarily mean we're going to go into a recession, but that rate of growth is just going to slow down a little bit. Potentially in Europe, they might be the laggards in terms of raising rates. The ECB has historically been quite cautious at raising rates. And I think they're likely to remain more accommodative than maybe their developed world counterparts. So potentially in Europe, you could see some good returns. I think we're still going to see that flow of assets coming out of government bonds. And as Paul says, that has to go somewhere. And so far that has been in equity markets. And we might see a bit more kind of regional specification there. I think in terms of what will probably do well over the next 12 months or so is inflation protected assets. So when you look at things like infrastructure, when you look at things like property, they'll probably do quite well and continue to do reasonably well. And I think there's been a huge focus on ESG investments over here in the UK, and it's something we adopt in our portfolios with the VAM funds. And I don't see any reason why that wave of investment into ESG is going to stop. So I think that's going to be a trend that we'll continue to see doing well over the course of this year. But in terms of equity markets, yeah, I'm sorry, I just don't see us producing double-digit returns this year, I'm afraid.
All right, I think we've got maybe 30% of our audience who's in line with you. Let's see how that goes. And Nilam, would you like to give us your views on the year ahead?
I think we all will agree to what Tom and Paul said. It's going to be a challenging year. It's not going to be a repeat of what we saw in 2020 to continue. And, a lot of emerging markets still reeling under that pressure because their governments are not as supportive as the developed world was. And the developed world is actually changing the pandemic into an endemic. So a lot of those changes are happening. I agree with Tom. Real estate, it is going to be bonds. It's going to be, you can't expect double-digit returns coming in. But yes, I think a change from China and Chinese government style, especially looking at the Olympics coming in the winter, I think they are going to be a lot more receptive, and that is going to benefit Europe. So it's going to be Europe, the emerging markets, and if you're looking at sectors, it's going to be financials and oil or energy, let me put it that way. That should be the sectors to look out for this year. But I think double digits is going to be really hard to come by this year.
Thank you. Thank you for that. I'm just going to get a little more in one area that I think has maybe surprised us a little bit. We were towards the end of last year, sort of coming out of COVID, I think a lot more freely. We were sort of, beginning to sort of go out, attend events, and then Omicron happened. And Paul, I'm going to bring you in here. And do you think, with the current way that we're going, we'll get back to normality after Omicron sooner than we had imagined? Or do you think it's sort of going to lead to a great reopening, given that with the fears of Omicron, we've seen there has been a little bit of a move backwards rather than, moving forwards?
Yeah, I think at the end of the day, Omicron has been good news. I think it's caused a short-term, probably caused a short-term slowdown in economies. Lockdowns were increased. There are supply chain issues. People are having to hide away and stay away from work because they've been infected or they know somebody who was infected. But I think the good part of it is that it is genuinely now, it appears to be a much milder version of COVID. And this is kind of what you would expect from these sorts of viruses, that they do weaken themselves over time in order that they can spread more freely. No virus wants to kill off its host, because if it kills off its host, it's got nowhere to go. And so they do tend to weaken. And I think, we just need to remember that the common cold is a coronavirus. So presumably at one stage, the common cold was a lot more impactful than it is today. So hopefully Omicron is a signal that we're on the road to the COVID becoming the equivalent of the common cold. We're clearly not there yet. It's going to need more mutations to get there, but I think we're starting that path. And therefore, yes, I think we can talk about the great reopening occurring during the course of this year, and I really look forward to being able to travel, to go out to the theatre, to cinemas, to restaurants, to visit family without really having to worry any longer about COVID, about testing. And I think we maybe just need to protect the highly vulnerable, but hopefully life can get back to something approaching normality. But there is different countries are in different stages, because part of the reason this has not been so dramatic is because a lot of the population in many countries is now vaccinated. So it's a combination of the virus weakening, but also the protection that the vaccine is giving. And so a country such as China does have the problem that it has had this zero COVID policy, which means that only a small part of the population has got any sort of immunity, especially since their vaccine doesn't seem to have been that effective. So they need to go through a slightly different process, maybe to the rest of the world. But I think an obvious sector to benefit from the great reopening is going to be travel and leisure.
Yep. And with that message of hope, we are going to go to our next poll question. And that's going to be up on your screen. I'm a little conscious of the time. We seem to have a very interesting discussion going. The question on the screen is, do you think prices are expected to rise faster than incomes? Is it likely, unlikely, or you don't know? So we'll come back to that, to the answer shortly. But in the meantime, I'm going to go to the next question that we've got. And it is one of inflation. We've touched upon it in during the points that we've had from our speakers before. But do you really see that as a concern in 2022? Do you think it's going to be a major part of that? Tom?
Yeah, I think inflation is really going to dominate markets over the course of 2022. I think it's going to be the key data point for central banks to focus on. I think it's fairly obvious that central banks are going to look to raise rates in 2022 and 2023. But a lot of that will be driven by inflation data, but also economic growth as well. So I think inflation is going to be a real focal point for markets. And I think where we've seen particular areas of the market thrive in low inflation environments over the last couple of years, or 18 months, shall we say, since the kind of worst part of the pandemic, actually the prospect of higher costs, things like that creeping into those businesses is going to start weighing on some of those assets. But I think it will continue to fuel cyclical sectors. We increased some cyclical exposure to the portfolios just before the turn of the year. And I think that's going to continue to be fueled as inflation picks up. But I think, we expect it to have a real grip on markets, and making sure that we have a diversified portfolio that's going to protect real returns for clients and investors is a really important factor. And I think, where we invest in infrastructure and property, we're not investing in, collective instruments. We're investing directly in quite specialist areas of that market and that industry to make sure that we're providing clients with a solid base of real returns that we can hopefully build from with the other assets that we're using.
Sure. Thank you for that, Tom. Paul, again, the same thing on inflation, and a little more, if we could delve into it from a sort of even an asset allocation perspective. So if you could cover both those aspects.
First of all, I think Tom mentioned earlier, inflation went higher than we had imagined. It has already gone higher. Secondly, I'm guessing, and I guess like many people, that inflation will peak out maybe sometime in the first half of this year, and then start to come back more towards what where the central banks would like to see it, where they are targeting it. But that might be a multi-year process to get down there. In terms of assets, well, first of all, as we've already mentioned, assets didn't really react to inflation last year. It was quite amazing. who would have thought that US inflation would go to 5 or 6%, and that it kind of the market shrugged their shoulders. But when you look historically at the performance of assets when inflation is on the rise and when inflation is high, it's very hard to find assets that give you any protection. It's really difficult to find those assets. There has been some historical correlation between inflation and commodities, but don't forget it was the commodities that were causing the inflation. So the direction of causality was the wrong way around. I'm guessing that if I were to say, if you were to say, okay, which assets do you think will mitigate inflation the best? Yes, I think we've already mentioned inflation protected bonds, but when you're buying those bonds, you're locking in negative real returns. You're locking in negative returns in doing that. So you've got to have quite a high hurdle to decide that you're going to do that. Somewhere like the UK, a 10-year gilt has got a negative yield of minus 2.75%. That's an inflation protected bond, that's the yield. So you've got to be pretty worried about everything else to think that that is a good investment. Otherwise, yeah, I'd still be willing to maybe imagine that commodities may give you some mitigation. Gold is a really interesting one because we tend to think of gold as protecting against inflation, but really since the financial crisis, it has gone the other way. Gold has tended to fall when inflation expectations rise. And that's because gold was being bought after the financial crisis because of fears of deflation and financial collapse. So gold, I think, is kind of is not quite sure what it's doing at the moment in terms of inflation protection. I personally think that if bond yields go up as a result of inflation, and not just because of inflation, but because real yields get driven higher, if bond yields rise, then assets such as gold and cryptocurrencies, those no yielding assets, will suffer. So I'm skeptical that in the short term that they will offer protection against inflation. It just becomes very difficult, I think, to get that protection.
Sure. Thank you. We've got the answers to our poll, and they should be up on our screen. And there you go. I think 81% of our audience is expecting prices, or rather are expecting prices to rise faster than incomes. We did see a little bit of a rise in incomes in the past year, and it looks like this year there is going to be that inflationary pressure that we were talking about come into play. We've got another poll, and I'm going to ask the team to if they can pull that up so that we can have that poll answered by our audience, and I think it's an interesting one. In relation to your portfolio, and this is for each of you who's attending, what is your biggest concern? Is it continued high inflation? Is it a less supportive central bank policy, or is it COVID-19 related slowdown in growth? So do put in your answers on the poll question, and a reminder to also put in your questions in the Q&A box. We've got quite a few questions and we'll try to get to them, which is why I'm rushing a little so that we could get enough time for our audience members to take their questions. So we've got a question for you, Tom, and then for you, Nilam, and then one for all of our three panelists. So what we'll do is I will go to Nilam for this question, and then we'll go to the poll results. Then we'll go to you, Tom, and Tom, and then Paul. Nilam, from a financial planning perspective, we're financial planners at the end of the day as a firm. When we look at investors and we look at the portfolios, and we're planning for that, what should we be looking for, and how should we be approaching it in this year? Your microphone is on mute, Nilam.
Now I was talking to myself. I think I wish we all had an answer to that. What should investors do? We actually don't know how the markets will react, and it's difficult to look at relying on any of the predictions. While we'll all, as market readers or market experts, would want to have predictions, and would want our predictions to come out true, it's very difficult. So I would say, instead of relying on predictions, we should enter 2022 fully confident. I think the base level is that nobody knows what will happen, barring the fact that we know that interest rates are expected to rise again. So many assumptions, so many decisions that are awaited, we do not know. So another thing that I would want to say is that it's not right to time the market by cashing out. Don't follow the crowd. Don't pile into the investment trend, which is followed by your friends, peers. We hear from everyone that a bear market is always following a high bull market, because everyone sees that valuations are high, and every investor wants to be, in that speculation mode and wants to make sure that their returns are actually encashed. Those things are true, but always bear markets don't follow. The market trajectory is a slightly longer one than what is predicted. So we cannot guarantee, or we do not look at a bear market in 2022 just because the market was expensive in 2021. And it's always interesting to know that all the great investors that we've known, they ignore all the noise that is created in the market, and they try and stay focused on their long-term goals. So it's very important as an investor to stick to your investment strategy, rebalance by taking your gains out if you have any high flyers in your portfolio, add investments, continue to diversify, and that diversification should also be into non-correlated assets that possibly you've not invested in. I think it's always advisable to keep a certain amount of margin of safety in cash and high quality bonds. So if there's any downturn, which may possibly occur, there are funds which are available to rebalance into stocks. I think it's very, very important to resist that temptation to click on market predictions and work, with that prediction. I would rather say work closely with your financial advisor, keep a check on your investments, continue to monitor and see if your investments are performing to the best of their abilities. If not, look at rebalancing based on the assessment. So the environment around is quite volatile. It's very important for you to keep a close watch on your investments. I think a financial review on a regular basis will give that chance to see if you're on track and if your goals need to be realigned to the current situation. So I think it's important to keep a check. That's my 2 cents on this.
Sound advice.
For all the investors.
Very sound advice, definitely. Thank you for that, Nilam. I couldn't agree with you more. I think we have the results of our poll question, and if the team gets it up on screen, there you go. 50% believe that we will see, or rather 50% of our audience, the biggest concern is continued high inflation, and with 31% fearing a COVID-19 related slowdown in growth. Very interesting. Very interesting to go to that. We'll go to Tom. Tom, again, from your perspective, looking at investors, if you had to give a quick soundbite, in terms of your advice to them for this year.
Yeah, I think just first, Anselm, I'll probably just touch on those poll result questions. So I think it's quite interesting. That fear of higher inflation obviously being reflected in with clients, but the fact that they feel that prices are going to rise ahead of incomes, and I think that's a key aspect. Paul touched on the fact that inflation is likely to peak within the first half of this year, but the reality is that it will probably run above trend or central bank targets, certainly, over the course of the remainder of the year and possibly heading into 2023 as well. For people with incomes, people who have their incomes revised once or twice a year, it's a one-off event. And if prices keep on rising, that becomes more and more of an issue. So I think it's an interesting kind of dynamic there. In terms of advice for this year, it's a lot easily said than done, but I think investors need to be patient. As I said at the very start, I think we are going to have a very volatile year. And what our role is going to be is to make sure that we've got our finger on the pulse to take advantage of those opportunities. But I think the key aspect for us is to make sure that we're doing our due diligence. I think it's going to be very easy to catch a falling knife in this market. I think we're already seeing some really strong sell-offs in certain assets where people have bought on sentiment as opposed to fundamentals. And our role is very much to make sure that we focus on the fundamentals and companies that are able to weather the stock market volatility, continue to produce decent results. And that's really where we'll be focusing on. So my only advice would be patient, make sure that you remember your long-term objectives that you've discussed with your advisors. What is it you want to achieve from this portfolio? Because it is very difficult to put it into context when you've had such an exceptional year like we did in 2021 in terms of stock market returns. And I think that's where clients are going to find it quite difficult to be able to adjust from that kind of year to possibly the year that we're going to have this year in 2022.
Excellent. Thank you for that. Paul, if you'd like to give us your sense of advice for investors for this year, and also if there are any warning signals or that you see, or any things that could cause market disruptions.
Yeah, I think the best advice is always buy low, sell high. And as Nilam was saying, you've got to have your disciplines in place. And for me, that means keeping an eye on valuations. But it also fits with what Nilam was saying about cashing out of the things that have done well, and maybe buying into the things that have done less well, but where you think there is an opportunity. I would say in general, diversification is obviously important, and that's an easy one to say. But also, as a wise portfolio manager said to me in London at the beginning of my career, don't worry about what's not in your portfolio. Only focus on what you have in the portfolio that you have put in there for good reasons, that you understand why it's in there. And of course, you're analyzing other assets all the time. But don't worry because your neighbor has told you that he's made a fortune from something that you don't have and that you don't understand. Don't think you've got to pile into that. Play your own game, buy what you understand, and only fret about what's in that portfolio, not what's going on outside of it.
Wise words indeed. And it reminds me of probably, I don't know, quite a few neighbors who've come and shown me their Bitcoin portfolios, and the zeros after the number seem to get longer, right? I mean, 4%, 400%, 4,000%. But yeah, I think that's very, very well said. Wise words indeed. We're going to go to I think this is the last poll question. And after this poll question, we're going to go straight to our audience question and answers. We're slightly behind time. And the poll question also is an interesting one. Which of these are you most likely to invest in 2022? This is a multiple choice answer, but do remember when you're answering this that most of us have limited amounts that we could invest, and spreading too thin may not give you the whole value. So from these sectors, from these themes, which one would you be most likely to invest in 2022? All right. While we wait for our audience to fill that in, we're going to have a look at the questions from our audience. And the first question is an interesting one. And Paul, that has got your name written all over it. And we're going to just wait while the screen is up and full. There you go. So should an investor consider diversifying part of their portfolio in crypto, NFT, metaverse, asset classes? If yes, what percentage is advisable, and what should be the mode of such investment, directly with the exchange or through mutual funds, etc.? So while I think it's a perfect vehicle for you to sort of provide your views with regard to crypto. And of course, if any of our other panel members would also like to address it, we could do so after Paul. Paul, over to you.
Yeah, I give a very approximate answer in terms of the proportion of the portfolio, of my portfolio, that I would put in these things, which is zero. I'm probably the worst person to ask about these things. I really do not get them. I always try to understand what it is that I'm buying when I buy something, and I think it's just very difficult with cryptocurrencies, and particularly with these. I can't digital art. Give me a break. I mean, I just do not get it. But these things are exchanging for a lot of money.
Yes.
I may be totally wrong on this. The metaverse is like, somebody's trying to make fools of us here as far as I'm concerned, but no doubt it will turn out to be a very important technology. Listen, when mobile phones first came out, my reaction was, who the hell wants to be contactable 24 hours a day? So what do I know? But no, personally speaking, I do not invest in these things because I think it's very difficult to understand what it is that you're getting, what you're buying into. You're effectively buying into something where there is a craze at that moment in time. And I don't think that is necessarily a great thing to be doing. But I caveat it with, I'm of a certain age where maybe I just don't understand these things. I'm too old.
Thank you for that, Paul. Would Nilam, Tom, would any of you like to address that?
Well, I completely echo the sentiments that Paul has. I think it's important to look at assets which you can feel in the real. It's very difficult to place assets when you don't know the pricing is accurate or not. And when we're talking about NFTs or metaverse or any of the cryptos, a lot of our clients who we deal with or we advise on would want to feel. There's no way that we can track these on a daily basis on their portfolios. And the second hurdle that I see is its availability. It's available on things which are not regulated. So there's a talk going on that crypto could be regulated, but we don't see that happening in the near future. Maybe there could be changes. So yes, Paul, I'm also a bit of that old school mentality to look at equities and bonds as hard assets in my portfolio and not these, and even commodities for that matter.
Yeah. So I'm going to give a little bit of a different reply to that. I'm just going to step my, put my foot in my mouth, if you will. But all I'd say is be a little sensible about it. I know that these are things that are exciting and in the moment. And if you're, fortunately, the buzz around is so strong, and we hear so much from so many people that many people that I know are going into it, and possibly without like both of our panelists have said, without understanding it well. So be sensible about it. If you were to learn about the stock markets, think about it. Historically, you knew nothing about the stock markets, and if you were to look at and try to learn about the stock markets, how would you approach it? You would go and read the research, you'd read the business papers, you try to understand the companies, get an understanding of crypto, get an understanding of NFTs before you go and put a large amount of money there. If you don't understand the asset class, if you don't understand it, it's going to be very difficult for you to do anything other than sort of speculate. So my advice, definitely, these are trends that possibly we cannot understand or predict how it will turn out. If you would like to sort of explore that, do it with a small portion, dip your big toe into it, don't put your full foot into it, and be a little cautious about it and study, understand it. All right, we've got our next question up on the screen. I need to know the expected returns we can expect from equities, especially BSE, or is there any alternative securities investments we can think of? Please advise. Nilam, I'm going to address this across to you.
Well, interesting question on the BSE. We've seen a marathon run on the BSE last year. And I think the markets have been volatile and kind of range bound in that 58 to 62,000 kind of range. If I look back, the last quarter of 2021 was actually a quarter where most of the asset management companies came out with a balanced advantage fund, which meant that the trend was going towards balancing your assets across equities and fixed income both. Which indicates that you cannot look at the similar return that the BSE delivered last year into 2022. Valuations are already high. I think BSE runs the highest valuations across. While it has been the second best performing market last year in 2021, we don't expect the same return. I would suggest as an alternate investment strategy, look at investing in these funds, which are balanced advantage funds across various asset management companies, or look at fund of funds which have a well-diversified portfolio. So you kind of avoid and circumvent that concentration risk that you may have. That's my advice to investors.
Excellent. Thank you. We've got a few more questions, and we're going to have our next one on screen. I'm cognizant of the fact that we're slightly over time, but we're going to take we'll take two more questions, and we'll end after that. All right. Are you expecting operating margins across companies to shrink due to rising costs like wages, etc.? How does that affect guidance for stocks going forward? Tom, would you like to take this on?
Yeah, absolutely. Yes, I think I agree with that. I think costs are going to increase for businesses. I think we've already seen minimum wages go up in the US, and they're likely to rise as inflation goes up as well. So I think that's naturally an adjustment that the stock market's having to make. When we've seen the S&P reach new highs, all of a sudden these companies that are trading on really expensive valuations that I mentioned earlier, we saw PEs in companies like PayPal, some very good businesses, but not justifying that level of valuation. And I think as costs begin to rise, for some companies it will be transparent, and it will be passed on then to the consumers to maintain margins. But not all companies are going to fit into that bracket. And I think it is going to be something that is going to weigh on stock market returns going forward. One thing I would also say is that during the second half of 2020 and 2021, certainly in 2021, we saw the percentage of companies beating consensus earnings at a record high. It was around about 85% of companies were beating consensus in terms of their earnings and their profitability. And the market rewarded them quite justifiably. However, companies that didn't meet those expectations really got hit quite hard. And I think we're going to continue to see that trend where companies aren't hitting expectations, and we're entering earnings season now. And I think that's going to drive a lot of the volatility that I spoke about earlier. And a lot of that is going to come down to cost control and whether that increase in costs can be passed on to consumers at the same time.
Yep. Awesome. Thank you for that. I think we've forgotten about our poll results in the midst of answering the questions from the audience. So the team can please, if you can put up the poll results to our last question. And there we have it. Technology seems to be clearly the favorite, followed by energy. That's interesting. And consumer staples, financials, and cryptocurrencies, all three sort of gaining a 25% share for the choice. So technology and energy, clearly the top two sort of sectors or areas that our audience seems to be indicating interest in. All right, we've got two more questions, and they're going to be quick ones. Let's have them up on screen. The first one is, will it be good to exit from stock investments or equity investments in 2022? I guess what he's trying to say is, given the fact that it's at a high, would this be the time to exit? And I'm going to go to I think Paul. Would you like to take that question, or we can get Nilam in as well?
Yeah, I wouldn't exit completely, but coming back to what Nilam was saying about, be careful to take profits when you've got them. Yeah. So in my model portfolio, I went from overweight equities to neutral towards the end of last year, just because they had done so well, and my projections for the year ahead weren't sufficiently good to keep me in an overweight position. But I certainly wouldn't exit equities completely, because again, I think as Nilam said, over the long term, equities are going to outperform bonds, and you don't want to be going from 100% to zero, because timing that is extremely difficult. But I think you can vary your, as markets go up, just take a bit out, as they come down, put more back in, and this may be an occasion to take some profits. And as the market swings during the course of the year, maybe just to vary those positions during those swings.
Perfect. And we have one last question that is going to be up on your screen before we call it today. I have a lot of cash. I like this investor already, and where to invest it today? Nilam, I'm going to go to you for this question.
Well, I have a lot of cash. Where do I invest today? I don't know what profile you carry, but yeah, I think I would go into the balanced approach again. I think it's important for us to be very cautious in these times. While markets look well poised to deliver returns, which are not going to be double digit, but single digit. But again, we have to take into account the fact that we do not know when to enter. So while we are not timing the market, it's important for us to look at what kind of investment objectives we carry, what kind of return expectations we carry. And are we looking at taking a lot of risk going into the market this time? No, I would want to be balanced this time. So my portfolio allocation would be possibly 60-40, the standard balanced portfolio approach into equities across, say, emerging markets, which have actually lagged over the last 1 year, Japan, Europe, which is going to benefit once China starts, looking at positive things and the government starts announcing a lot more positive measures. India, possibly in certain sectors, not in the BSE, but yeah, there are a lot of stories that we see. There are a lot of stories we can still pick on. So those stories is what we would want to tell them. So yes, if there's a lot of cash, do reach out to us and we'll help you put that cash in the right direction.
Excellent. And I couldn't agree with you more. It all starts with a financial review. Do reach out to your advisor. If you don't have an advisor, reach out to us. We'll be happy to assign one to work with you. So the first step is to be able to get a financial review. We do have free financial reviews for new clients that we offer. And for those of you looking to get and enter into investments and markets, please do reach out to the team. Leave in your number and they'll be able to set you up with one of our experts. A very big thank you. We're slightly over time. I hope we've been able to get to all of the questions. I know that there are a few questions that we will send responses to by email. But in the interest of keeping time, a very big thank you, first of all, to both VAM funds as well as Invesco, and to our guests, Tom and Paul. If this were, a live audience, I would ask them to give a big round of applause. But I'm going to do it on behalf of everyone. Thank you so much, Tom, Paul, and Nilam, for joining us today and sharing your experience, your knowledge, your thoughts with us, and some very interesting sayings as well. Of course, to you, Nilam, big thank you to you, and last but not the least at all, to all of our attendees, a big thank you, not for your time, but for your attention. I hope that you've listened and heard what our experts have had to say. As you exit, we'll have a short feedback form for you. Please do take that moment to fill it in. It does help us to be able to structure and create more of these events for you. To all of you, have a wonderful evening, and I hope to see you at many more webinars or in person sometime in the future. So thank you.